I'm pleased to be talking at the conference on the Capital Markets Union. I spoke here in September 2013 on regulation, and I think this is a progression. And for someone who's been involved in a firm which has invested in private debt for a long time, this green paper is very welcome. I mean, just by way of background, M&G, I work for M&G, the European fund management arm of Prudential plc. I joined in 1997 to start a number of private debt activities along the lines of US insurance companies. And since then, we've been one of the first institutions to invest in private placements, infrastructure finance, leverage finance, structured credit, including securitizations. And these funds have expanded now not only for insurance monies, but also pension funds. So you can now see why this green paper is so welcome, as it's probably the first official endorsement for building expertise outside the banks. So linking investors and savers into key economic activities. However, if only it was as simple as just hitting a switch. I wish if all the times I've been asked, what one issue can we do to get more investors involved in illiquid assets or a number of these activities, I probably wouldn't be speaking here today. The key issue really, if we look at it, and I think this is covered in the green paper, is how does money move around the economy? Historically and currently, the Europe financial system is built around the banks. And I think it's made clear quite early on in the paper, in fact, page 2 of the green paper, that this has got to change. And statements like range of steps required, not a single measure, need to identify and remove the barriers between investors, money and investment opportunities, make investment chain as efficient as possible. So how I describe it is, let's get the plumbing working. Or they use the expression, as Philip talked, about the investment chain. And I think this is what the paper's about. But I think its key is changing the mindset of that the banks are the only solution. And that is going to take time. But actually, that's probably been required since the credit crisis occurred. So we're probably, if this exercise had been done 3 or 4 years ago, that would probably have been better. So unfortunately, because of efforts of, we've tried, obviously, and have started a number of new activities, it does take time for a lot of these new activities to be accepted. But I'm reassured that people in influential positions now do recognise that. I'm going to cover, rather than things like private placements or infrastructure finance directly, I'm going to talk about regulation, securitisation, and LTIFs. I mean, in the post-credit crisis environment, it was understandable that we'd get more regulations and it would be tightened, new ones created, even in areas where certain sectors did well in the crisis. But if the result of these regulations is that the plumbing doesn't work and that funding is not available to SMEs and other economic activities, is that the right result? I mean, last time when I spoke, I talked about an issue under AIFMD, which meant that when we invest in securitization, the retention rules, which in the US is policed by the banking regulator, so the banking regulator says, you've a bank, when you launch one, have you kept your 5% or retention? In Europe, we create a system where the investors had to be the police. So therefore, and I'm not going to go into too much detail on that, but what it meant was we, rather than have to keep asking banks on a monthly basis, are you still keeping your 5%? We asked them to warrant it. What the banks, in some situations, did is said, well, actually, if we sell to non-European fund managers, we don't have to give that warranty. So a number of SME, ABS, and other went to overseas investors. So if we're looking at the investment chain, hopefully this is what the green paper's about. We have actually pointed out to the Bank of England, ECB and others, but I see this green paper as an opportunity to be looking at regulations and where it's not worked. I mean, on a general point, I was amused in the paper. On page 5, it talks about all the various regulations, MiFID II, market abuse, AFIMD, European market infrastructure and that. And just above it, about 2 centimetres above, it says what the aim of a paper is to improve access to financing, increasing and diversifying the sources of funding, markets work more effectively and efficiently. I'd like someone to work out if each of those regulations achieve those 3 aims. It'd be nice to see that this paper does that work. So, just finally on regulation, a phrase I would use is, even if there's not less regulation, let's just have better regulation. I mean, moving on to securitization, there's obviously a separate consultation document with the aim to develop really a high-quality market. We've been involved in this market for many years, and I suppose we've been very frustrated about the tone of comments about this market and actual regulations, and whether it's draft ones or ones which are coming in. Because the defaults in Europe per annum were under 0.2% or 20 basis points. The US, who had at the time 10% defaults due to the subprime crisis, which was the home of the crisis, they restarted their ABS market immediately. And we're now, 6, 7 years. It just doesn't, to me, stack up. So we welcome this consultation document. And we've had a number of successful discussions with external investors who have invested in ABS distinctly as an asset class in a specific segregated mandate in ABS. So that's good news. So let me give another example of unintended consequences. The ECB have started buying ABS for good intentions to increase the amount of issuance. So what has happened? Well, high-quality securitization has moved from a credit spread, and this is the highest tranches, from about 80 basis points to under 20. So you picture going to see external investors to say this asset class has good relative value when the return has completely, not disappeared, but let's say declined, to me is an unintended consequence if you're trying to rebuild the market. So, and I think that if the general view is that banks are going to be more regulated and have to have greater capital, Europe needs a fully functioning securitization market. And hopefully this consultation paper will help on that. Last topic I want to talk about is LTIFs. As I've mentioned, I've been involved in illiquid assets since 1997 on behalf of internal insurance monies and then expanding that into pension funds. So therefore, this initiative, the LTIF initiative, is excellent because it actually makes it specific. It's going to expand the investor base into, let's call it what is called the wealthy mass affluent, and maybe later general retail. And what is, I suppose, from my discussions with various people in the European Commission on this and others, is the focus on long-term investment. I mean, I would call it the need for patient capital. Do investors really need daily trading and daily pricing when they make investments? And as I would explain it, here is a closed-ended fund, an LTIF, with this particular type of illiquid asset in it, with these projected cash flows, and here are the risks to those cash flows. And as long as it's explained up front, we view that very positively. So I think it can make a real difference, this LTIF initiative, and I look forward to hearing more details in the coming months as the detail comes out. So in summary, we welcome the Green Paper and look forward to working and talking with the European Commission on it to try and get the plumbing, or as they call it, the investment chain working. Thank you.